merger with Canada HSBC OBC Life Insurance. Is a joint venture between Canada, HSBC, primarily. I mean, those are the two big partners. Thank you very much, ma'am. Appreciate you joining in with this morning. I was reading some of your comments given to a publication just a few days back, and you were talking about the resilience shown by retail individuals, retail investors, handing over money to institutions, mutual funds and insurance companies, even as the market through August and September have looked a little volatile. They've kind of sort of continued to participate. I just want to ask you, how much of this buying that investing that we are seeing is, according to you, approximately systematic investing, and how much of this is discretionary? And we've had months of very large inflows, especially into equity mutual funds.
Thanks, Prashant, for having me on the show. It has, of course, been a well-documented and spoken fact that over the last couple of months, as we saw FII interest and participation in Indian markets are waning, and we saw outflows. Indian domestic investors continue to bring in money through mutual funds, insurance companies like ourselves. And we have seen the selling having been matched by the purchases. Now, when you see volatility in the market and FII selling, it is unusual to see domestic investors continue to pump money, and I hope it sustains, because I think volatility remains to be the order of the day, and next couple of months will be as challenging, if not more, than the last couple of months. It's good to see that the proportion of systematic investing has gone up, though I don't have a number to differentiate between the discretionary and systematic investment, but the industry data indicates there is now a larger proportion of systematic investment, especially from retailers.
You know, do you expect flows to remain strong? It could be a function of the market as well, right, ma'am? I mean, so we've been getting about $1.5 billion every. In September, that number came down to about $100 million. Ideally, people should put in money when markets are low, not at all. But that's not how it works, right? We would like it to work that way, but money comes in during peaks. So if markets do not remain strong, what's your expectation? Or you think, well, this is a tide and the tap is on, it's going to, it won't close for a long time?
I have a different point of view from Prashant on this. We have actually seen a year of muted returns. Last year gave good returns, especially in equity market. This year has been a market of debt. Debt funds have given double-digit returns, while equity has remained muted. So it is good to see that retail investment continues to be strong despite not having made great returns in recent past. What is important is retail investor understands the long-term nature of the market, and the nature which really helps build wealth is to have systematic regular investment. It is important to have your goals and targets defined and an asset allocation agreed, after which not much discretion should be applied by retail investors. We believe they should stick with that pattern and do an annual review, if at all, to see if the investments are moving in line with expectations, but not meddle too much intermittently between the asset allocation.
Okay, all right, fair enough. I mean, I want to ask you what your view is, though, on markets from here. Do you think, and I'm not talking about a very long term, you of course manage money for fairly long periods of time, but most investors, retail investors, would like to see sort of, themselves making money over reasonable time frames, right? Not very long time frames. So, say the next year or so, what's your forecast? Well, are markets looking pretty, or it looks very unclear? The path looks very unclear.
To make money in equity markets, one needs to have a minimum of 3 to 5 years. 1 year is very shorter time frame. If someone invested with the same time frame last year, they would have made no money at all, would have been in negative. As we know, last 1 year markets have had very tepid returns, have been swinging between plus minus small digits on both sides. So really 1 year is too short a time frame. Then it is largely trading. There's sharp stock specific movement, and one needs to ride that if one wants to make money in the short term. But sustained returns will be 3 to 5 years. Next couple of months, I believe, will continue to be volatility, as you just asked, because the corporate earnings and growth is yet to return, while the macroeconomic situation looks improving progressively. A rate cut was anticipated, we have that now. IIP numbers are better than anticipated. So the macroeconomics, be it currency, be it our reserves, be it inflation, IIP, capital offtakes, stall projects number reducing. So a lot of green shoots on the macroeconomic front. These need to now translate into a GDP growth and need to translate into improvement in corporate profits and revenue numbers. That's not likely to happen till a couple of more quarters, I believe, and hence there's no real stimulus for the market to have a very stupendous run from here in near future. But I believe that we are poised for a bull market for next 3 to 5 years where a double-digit CAGR should be made. But then, like we started the conversation with, that requires systematic investment and patience and resilience to hold through the volatility.
Okay. No, so I mean, it's possible that the next 1 year as well, one may end up with flat kind of returns? I know that, you know, at least 3-year kind of time horizon is necessary. Yes, but I'm just asking you for your opinion.
Last October, when the market was on a bull run, when last October around Diwali,
same time next year, it will be 2 years of flat returns or no returns.
Like I said, last Diwali on one of your channels, they asked me to put my neck out and say what would it be at next Diwali, and I said 30,000 Sensex. It sounded quite difficult at that time because we were in midst of a very strong momentum, but it looks like that itself is an optimistic number, looking at it today, a month from Diwali. So I think a year is a long term. Next couple of quarters, if we start seeing improvement in the corporate results, and market will start discounting the good news, and we may see actually market responding larger than proportion and giving a much better return than the actual improvement in corporate results, because that shows a reversal in trend as far as corporate profitability is concerned. Hence, any indication, sustainable indication on the front of growth returning or results improving, I think will give market the stimulus to have a good run after that.
Okay, all right, fair enough. You think, so you know, these are the consensus overweight sectors across people that I speak to daily. Private banks, NBFCs, right? Most institutional money like, be it mutual funds, insurance companies, FIIs. Then there's consumer discretionaries. It could be autos, auto ancillaries, that list, and IT and pharma. Now everybody likes infrastructure and the infrastructure revival story, but nobody is willing to bite in yet. They all bite at some distant point in the future. I want to ask you for your list, ma'am. What constitutes the best areas to pick stocks from at this point, where in absolute terms, the majority of the money will be made?
I thought you were reading out my list. Needless to say, it is pretty similar, but there's a reason for that. We prefer to invest in sectors and stocks which have earnings visibility, showing, and it's not very difficult to find many such sectors or stocks at this point in time. Private sector banks clearly have been showing increasingly better results quarter on quarter, and even gaining market share to public sector bank. The asset quality is better, margins have been sturdy. Of course, we may see a little pressure this quarter, but that would be across the banking sector. So yes, they continue to be a favorite, followed by auto, pharma, pretty much the sectors you spoke of. But the logic behind them is largely good governance, earnings visibility, and a good management at the companies there. We have a bias for large caps at this point in time, considering that as we see a recovery, large caps will lead the rally rather than caps which already look quite overvalued. We actually also have a good exposure to capital goods and infrastructure. There, a fair bit of patience is what is being demonstrated by us, because these are not stocks and sectors performing. But here again, we prefer companies where we see orders in pipeline. Things like road sector is what we like, where we see action already in the making. So one needs to be very selective and have patience. But clearly, the rally will be led by banking and cyclicals as well as infra-cap kind of sectors, but that is a couple of quarters away.
Ma'am, quick conversation today. Thank you very much for your time. Good speaking with you. Thanks indeed.